Today is our training session about annual compliances in capital flow. After completion of this session, we hope that you will get an idea about annual compliances. Our experts will help you in providing services to the people easily to start and grow the business from proprietorship annual compliances to statutory audit. Compliances means action to complying with law, and annual means a year. Annual compliances means covering all the legal requirements for the whole year to avoid legal penalties. We in annual compliance provide 7 types of compliances: audits, proprietorship annual compliances, partnership firm annual compliances, limited liability partnership annual compliances, private limited company annual compliances, tax audit, internal audit, statutory audit. Proprietorship annual compliances. Proprietorship annual compliances mainly includes filing of income tax return within due date. In addition to the basic compliance, proprietorship also be required to comply with TDS regulations, GST regulations. Like other entities which are registered under the Ministry of Corporate Affairs, the sole proprietorship are not required to file any annual report or financial statements with the Ministry of Corporate Affairs. Taxpayer other than the private limited companies, one-person companies, LLPs, partnership, limited companies are to be called as individual or proprietor. Main compliances of proprietorship are ITR filing annually and comply with other regulations. Documents required for proprietorship annual compliances: invoices of purchases and sales during the year, invoices of expenses incurred during the year, bank statements from 1st April to the 31st of March for all bank accounts in the name of business, credit card statements if expenses are incurred by proprietor on behalf of business, copy of TDS challenge deposited, TDS returns filed, if any, copy of GST returns filed, if any. Due dates for proprietorship. Income tax return, 31st July. If the proprietor income crosses the basic limit of exempted income tax limit, rupees 2,50,000, then it is mandatory for him to file the income tax return. GST returns, 20th of the following month. A proprietor whose business is registered under the GST Act required to file GST returns on monthly basis. Partnership firm annual compliances. Annual compliances for partnership firm is a legal requirement of income tax to file annual income tax return irrespective of profit or loss. Under the Income Tax Act, the partnership firm is treated as an entity is separate from the partners of the firm. Why to follow annual compliances? As we have to intimate the department about our incomes and expenditures and to make our firm free from non-compliances. If we fail to file income tax return and GST returns as per due date, then penalty is imposed by the department. Documents required for partnership firm annual compliances: purchases and sales invoice, expenses invoice, bank statement from 1st April to 31st March of the relevant financial year for all bank accounts in the name of the firm, copy of TDS challenge deposited, TDS returns filed, copy of GST returns filed, if any, income tax return, ITR Form 5, ITR Form 4, if firm is applicable to presumptive taxation. Due dates for partnership firm annual compliances: 31st July, normal income tax return, 30th September, if tax audit is applicable, 20th of following month, GSTR 3B, if they registered under GST Act. Limited liability partnership annual compliances. Limited liability partnerships, LLPs, has less number of compliances to fulfill in contrast to private limited companies. LLPs need only file information related to the statement of accounts and annual returns on an annual basis. Every LLP should intimate the department about their incomes and expenditures, and other details of the company annually, to the Income Tax Department and Registrar of Companies. Documents required for LLP annual compliances: invoices and statement, invoices of purchases and sales, expenses invoice, books of accounts and financial statements, returns, copy of TDS challenge deposited and TDS returns filed, GST returns, if LLP registered under GST Act. Important points. Audit. LLPs whose turnover is more than rupees 60 lakhs or whose contribution has exceeded rupees 25 lakhs have to get the books of account get tax audit by practicing chartered accountant. Filing. File income tax return with Income Tax Department and also file annual accounts with Registrar of Companies. Penalty. In case of failure, penalty will be imposed for LLPs rupees 100 per day per form and will applicable from after the due date till the date actual return will file. It may exceed up to rupees 5 lakhs. Due dates for LLP's annual compliances with Income Tax Department: 31st July, applicable for LLPs not required to get tax audit; 30th September, applicable for LLPs required to get tax audit, required to file ITR Form 5 with Registrar of Companies; 30th May, Form 11, Annual Return. This form includes summary of management affairs of LLP, numbers of partners along with their names. 30th October, Form 8, Annual Accounts. This form includes details about profit made and other financial data. Private Limited Company Annual Compliances. Under a private limited company, there is a limited liability protection and have various benefits such as raise fund from venture capitalist, continuous existence. It is required for every private limited company to conduct its annual general meeting each financial year and file an annual return with the Ministry of Corporate Affairs to maintain compliances. As every company have to intimate the department about the incomes and expenditures and information regarding shareholders, meetings etc. and to make company free from non-compliances. Every private limited company is required to maintain compliances as per Income Tax Act 1961, GST compliances, and Companies Act 2013. In case of a newly incorporated company, the annual general meeting must be held within 18 months from the date of incorporation or within 9 months from the date of closing of the first financial year, whichever is earlier. Whereas in case of a subsequent annual general meeting, it should be held within 6 months from the end of financial year. Annual compliances consist of the following: audited balance sheet of the company, audited profit and loss account, registered office details, register of member details, shares and debentures details, debt details, information about the management of the company, current details and details of the change in the shareholding structure of the company, detail about the changes in directorship, details of transfers of securities or shares in a financial year. Documents required for private limited company annual compliances: profit and loss account, balance sheet of company and other financial statements, directors' report and auditors' report, list of shareholders and directors and other required documents, if any. Benefits of private limited company annual compliances. Separate legal entity. A company is a separate legal entity and a juristic person under the Act. Therefore, a company can own property in its own name and also incur debts. The members, shareholders, and directors of a company have no liability to the creditors of a company for such debts. Being a juristic person, a company can acquire, own, enjoy and alienate property in its own name. Share transferability. Shares of a company limited by shares are easily transferable by a shareholder to any other person. Shares can be easily transferred by filing and signing a share transfer form and handing over the buyer of the shares along with share certificate. Perpetual succession. A company, being a separate legal person, is unaffected by the death of any member, but continues to be in existence irrespective of the changes in membership. A company has perpetual succession which has uninterrupted existence until it is legally dissolved. Due dates. ITR Form 6 to Income Tax Department within 30th September. Form AOC 4 within 30 days from the date of Annual General Meeting to Registrar of Companies. Form MGT 7 within 60 days from the date of Annual General Meeting to Registrar of Companies. Important points. Who is required to sign the reports? Annual filing e-forms are required to be signed digitally by the director of a company and chartered accountant or company secretary. Consequences or penalty. If we fail to do so, then penalty is imposed for not filing a company's annual return. Form MGT 7 and Form AOC 4 is rupees 200 per day. In case company fails to file its annual return to Registrar of Companies, it is punishable with a fine which shall not be less than rupees 50,000 but which may extend to rupees 5 lakhs. Tax audit. Before knowing about tax audit, we should know about the term audit. The term audit suggests that it is an official inspection of an organization's accounts and production of report, typically by an independent body. There are various kinds of audit being conducted under different laws such as company audit, statutory audit, conducted under company law provisions, cost audit, stock audit, etc. What is tax audit? Tax audit is the verification of the books of accounts of an assessee to validate the income tax computation and compliance with the laws of income tax. Who is required to do audit? Auditing of books of accounts must be carried out by a practicing chartered accountant. Tax audit is an examination or review of accounts of any business or profession carried out by taxpayers from an income tax. Objectives of tax audit: ensure proper maintenance and correctness of books of accounts and certification of the same by a tax auditor. Reporting observations or discrepancies noted by tax auditor after a methodical examination of the books of accounts. To report prescribed information such as tax depreciation, compliance of various provisions of income tax law, etc. All these enable tax authorities in verifying the correctness of income tax returns filed by the taxpayer. Calculation and verification of total income, claim for deductions, etc. also becomes easier. Who is required to get tax audit? Business. In case of a business, tax audit would be required if the total sales turnover or gross receipts in the business exceeds rupees 1 crore in any previous year, even in case of loss. Profession. In case of a profession or professional, tax audit would be required if gross receipts in the profession exceeds rupees 50 lakhs in any of the previous year. Every person who is carrying a business whose turnover exceeds rupees 1 crore or 2 crores, in case registered under GST Act, or who is carrying a profession whose receipts exceeds rupees 50 lakhs in the financial year, must get his accounts audited before filing return. If any taxpayer who is required to get the tax audit but fails to do so, the least of the following may be levied as a penalty. 1. 0.5% of the total sales, turnover or gross receipts. 2. Rupees 1,50,000. Books of accounts to be maintained by business or professional. A cash book, that is a record of all cash receipts and payments, day-to-day transactions. Journals, ledgers, carbon copies of bills, serially numbered, exceeding rupees 25, issued by the person. Original bills or receipts issued to him in respect of expenditure, payment voucher. Tax audit report constitutes. Form number 3CA is furnished when a person carrying on business or profession is already mandated to get his accounts audited under any other law. Form number 3CB is furnished when a person carrying on business or profession is not required to get his accounts audited under any other law. Important note: in case of either of the aforementioned audit reports, tax auditor must furnish the prescribed particulars in form number 3CD, which forms part of audit report. Internal audit. Internal audits evaluate a company's internal controls, including its corporate governance and accounting processes. They ensure compliances with laws and regulations and accurate and timely financial reporting and data collection. Internal audit is a type of consulting engagement and an objective assessment of an enterprise's operations. Internal audits, conducted to assess the strengths and weakness of financial, operational and information technology systems of company. Hence, a good internal audit not only provides assurance, but also consulting to help the business improves or mitigate weakness. Benefits of internal audit. Management tool. An internal audit can help provide an independent and objective opinion about the operations of a business. Hence, internal audits serve as a management tool for good governance. Early warning. Internal audits provide early warning to the management on deficiencies or loopholes in the business. Thus, internal audits can help to prevent costly mistakes or frauds in the business. Improves accountability. Having a strong internal audit mechanism with surprise check will help improve accountability of the employees and ensure that systems and processes are followed properly. Objectives of internal audit. Know what and when to audit. Before conducting the internal audit, you should identify what processes are going to be audited. Understanding the scope and objectives of the audit process will help you create an audit schedule. Create an audit schedule. Creating an audit schedule provides the departments with an advance notice of the upcoming audit. The program will help them have the necessary documentation and records available for review and audit. Pre-planning the scheduled audit. During the pre-planning phase, auditors need to send an audit plan to department providing information about the audit scope, objective, criteria and possible documentation evidence needed for the audit. Conducting the audit. Internal audit can be conducted by different methods such as documentation review, interviewing and observation. Based on the scope and objective of the auditor, the audit shall choose any methodology or combination of all to carry the internal audit. Record the findings. Recording the findings is vital in the audit process. An auditor needs to list all evidences cited by record number or record data. The aim of documenting audit findings is to identify gaps in compliance and look at opportunities to fix the deficit and improve the process. Report the findings. All findings should be reported in an easy-to-read audit report. Audit reports serve evidence that an internal audit was conducted. These reports should be reviewed and approved by the department manager or top management. Applicability of tax audit. Every listed company, every unlisted public company having paid up share capital of rupees 50 crores or more during the preceding financial year, turnover of rupees 200 crores or more during the preceding financial year, outstanding loans or borrowings from banks or public financial institutions rupees 100 crores or more at any point of time during the preceding financial year. Outstanding deposits of rupees 25 crores or more at any point of time during the preceding financial year. Every private company having turnover of rupees 200 crores or more during the preceding financial year. Outstanding loans or borrowings from banks or public financial institutions rupees 100 crores or more at any point of time during the preceding financial year. Process. The time duration for completing an internal audit would depend on the audit objectives and scope. Statutory audit. Statutory audit is a type of audit which is mandated by a statute or law to ensure true and fair view of the books of accounts of a business is presented to the regulators and the public. Statutory audits must be completed by practicing chartered accountant who are independent of the business. A statutory audit is a legally required review of the accuracy of a company's or government's financial statements and records. The primary objective of the statutory audit is to ensure that the financial statement, such as balance sheet, profit and loss account, etc., provides a true and fair view of the company financial state of affairs. Audit. Applicability. For private company or public company, mandatory, irrespective of turnover, profits, etc. If the company is incurring loss, Even then, statutory audit is required. For limited liability partnership, it is applicable if turnover in any financial year exceeds rupees 60 lakhs or its contribution exceeds rupees 25 lakhs. Checklist: Profit and loss account. In the case of profit and loss account, care should be taken for the individual breakups of sale and services. Purchases verification, expenses verification, preliminary expenses verification. Balance sheet. To see any resolution pass for increase in share capital, how many number of share issued. Verify whether the share capital changes are there and whether the changes are authorized under proper resolution. Secured loans. Fixed assets verification, opening balance verification, vouching, cash vouching, journal vouching, bank reconciliation statement. Objectives of statutory audit. Prepare audit scope. Prior to starting the statutory audit, the auditor should obtain an understanding of the business and scope. Conduct audit. Verify the information presented on the financial statements, obtain samples and verify the data used to prepare the books and to conduct the audit. Record findings. Record the findings and coordinate with top management. Report findings. Report the findings in the audit report and get approval from the top management. Process. The time duration for completing a statutory audit would depend on the audit objectives and scope. Thank you for watching.